I get a lot of questions in my business and my practice about the success that I've had. And I really don't look at myself as success. I just simply look at myself as I made a ton of mistakes and I learned from them and I moved forward very quickly. And so those mistakes that I feel like that I have made, and there's 7 of them, we're going to talk about those 7 mistakes today. My name is Gus Robertson and Financial Dad. And the content that I put out is mostly for families. It's mostly for how to educate yourself and as well as your kids for the future and put you on a solid path. But so today we're going to talk about the 7 mistakes I think are pertinent for people to just stay away from. I think it's super important, and I think that these are pretty simple mistakes that I see a large majority of my clients and people that I talk to, and even people online that they make. So I'm going to hit on 7 mistakes I believe that people make. Number 1 is kind of broad sweeping, which is social media. And what I mean by social media is great. I get a lot of motivation from social media, but social media only preaches the pros. It doesn't really talk about the 30 steps that it takes to get to that. So we'll go over that in a minute. We'll go over that briefly. With investing, so what I'll do is I'll break this down. With investing, there's 2 mistakes. With insurance, there's 2 mistakes. And with real estate, there's 2 mistakes. So with investing, I see a lot of it is just too much financial responsibility too early. The second one is just a basic misunderstanding of how important time is, and that's for investing. With insurance, it's not understanding that insurance is not an investment. That's a big mistake that I see. Number 2, most insurance products are purchased out of fear. With real estate, and we're talking about investment real estate, what I see in social media is that people read a book, they take a class, and it's just not real. The concepts are real. Again, it's almost like the social media part of it is they paint a picture of how easy everything is, and it's just not that easy. And number 2 with real estate is people actually believing that real estate is there to provide income. Those are the mistakes I see with real estate in regards to investment real estate. And so that's what we're going to talk about today. And so number 1 is social media. So in 2024, social media is way different than it was, let's say last year. And so social media only points out the pros of how easy it is. A large majority of the time, you have to understand that people are trying to get you to buy a concept, to buy a book, to buy a program, to buy whatever. I don't care if it's $9.99 or if it's $5,000. The point of it is to get you to buy into their method of what they believe in. And whether it's business or whether it's investing, what they're not saying is that a lot of investing is a long-term game. It's a long-term play. And that's what they are not preaching. They want you to buy their program and then that's it. So I use social media as motivation. I think there's a lot of great content out there, and that kind of gets you like pumped up and gets you interested in finding out more about how to invest in your future. But you have to take it with a grain of salt. You have to educate yourself, and no matter what we're talking about, whether it's investing or whatever, it's you have to do your due diligence in finding out the information that best suits what you're trying to do. So my best example is this. So I remember my first job I was 23, straight out of college, and I worked with a national insurance company. And so my agency manager at that time was 65 years old. So he was a great guy. He had a lot of knowledge in regards to insurance, investments, and real estate. And he talked with all of us about that. And but I was the youngest person in that office by probably 10 years. Everybody else had mortgages, wives, kids, and I was just a single dude that was just really interested in all facets of investing. So I would talk with him a lot. And I remember about a year into my job, he invited me to a group of men that got together, and all they did was talk about investments. And what it was is that every member of the group, and this was a hardship for me at 23 years old, every member of the group, you put in an initial $1,000. By the way, I had to borrow that $1,000 from my dad. And you put in $1,000, and then and that was your buy-in to make sure that you were serious about it. And then everybody, there was 15 of us, we put in $200 a month, and we met once a month at this one guy's house, and there was food, and there was drinks, and there was TV, but then there was a 30 minutes of where we all sat around as a group. We talked about investments, we talked about the stock market, and I was the youngest person by 30 years, at least 30 years. But the one thing that I learned about that from all of those guys, that I look at it now from like the social media standpoint, and then meeting with those guys, was all of them had a long-term outlook on investing. It wasn't short-term. It wasn't buy, sell, wait for the market to go up and go down. It was buy and hold. And the market goes up, and then the stock is worth more. And so, and every month, a guy would come in that was a financial planner, and he would talk to us about stock that was looking good. And we would make a choice to buy as a group. Everybody had to, I think there had to be like an 80% majority. And then we would buy stock, and that was my intro to basically, financial planning was in that group, and I was in that group for almost 3 years. Whenever I got out of that group, I had made probably 20% on the money that I had put into that. My point behind that is be very careful about where you're getting your investing and your advice from. Social media, again, is great. It's great for motivation. But whenever it comes to actual practical, this is what you do, just be very careful about where you get that information from. Whenever it comes to investing, the two mistakes I see most people make is taking on too much financial responsibility too early. So I talk about this a lot. So I have a 20-year-old daughter. I have 5 kids. The 20-year-old is my oldest. And so I talk with her all the time about taking on too much staple financial responsibility, whether or not that's a car, whether or not that's a dog, whether or not that's just impulse buy. You have to be very careful about spending money that you make and then having an ongoing payment. And so my best advice for her on that is equate everything out to, if she makes 20 bucks an hour and something costs 100 bucks, she's got to work 5 hours to pay for that. And that's an easy concept for a lot of kids who are starting out in their job to, put a dollar value or a time value on that purchase. The second thing is time. Time is the greatest gift that we're all given. When you're 20 years old or 30 years old, you don't really think about time. When you get upwards in your 40s and things, you really start to understand the time value of money. My greatest example of that is this. So my 20-year-old, so my wife and I, we have set up every child with when they turn 20 years old, 18 to 20, we're going to set them up with a Roth IRA. Not to get into a Roth, but it's just a simple investment tool. And we are going to self-manage that. The reason why we're self-managing it is because I don't want to pay fees, and I know how to do it. Anybody can do it. You can learn how to do it with a 30-minute YouTube video. And what you're doing is you're bypassing the financial planner and the 1% or greater fees per year, and you're just self-managing it. But what we're going to do, my example about time is this. My 20-year-old can take $200 a month at 20 years old and invest $200 a month for 10 years. That's $24,000 over 10 years, so from 20 to 30. So from 20 to 30, she put in $24,000 and then completely stopped. Never put another penny in that, and just getting just regular market returns just based off of the history of the stock market. When she is 60 years old, now this is bare bones, this is foundation stuff. She can do whatever she wants to do in the future, but in regards to investing, but if she just did this, when she is 60 years old, she's got $1 million in that account. But you take the same if she waited until she was 30. If she were 30 and didn't do any investing, she would have to put $400 a month in there for 30 years, so from 30 to 60, to have the same amount of money. That is how the time value of money works. So again, 20 to 30, she puts in 200 bucks a month for 10 years and then stops $1 million. If she waits until she's 30 and she's got to put in $400 a month for 30 years in order to have the same amount of money. So that's how the time value of money works. And it's very important. And I think that if people studied that even just a little bit, they would understand how compound interest works, as well as, and that's where I see a big mistake, is that people wait. They're waiting for some greater day, some greater thing to start. And that day never comes, because things are just going to happen, and it kind of sidetracks people from their ultimate goal. The next thing is insurance. So insurance is how I started my business. I was 23. I worked with a national insurance company where it was a captive agency. And we sold every insurance product as well as every financial product. At the time, that was big, where insurance companies were trying to get into the banking and the financial field. And so I'm pretty well versed on all things financial and insurance. But in insurance, especially whenever it comes to life insurance, and I'll say this until the day I die. I say it on almost every podcast. Insurance is not an investment. Don't let anybody trick you into believing that insurance is an investment tool. It's not a wealth building tool. In my career as an insurance broker and a financial planner, I have never once proposed a client to take out an insurance product to build wealth. It's never happened. I've never done it, and I've never seen it. I've never seen anybody propose an insurance product to build wealth. Now, there are products out there that once you already are wealthy and you have already set the blueprint and you've lived to it, and you've lived up to that then there are insurance products out there. So this is not a broad sweeping term. I'm using it as saying insurance is not an investment, and it is not used for wealth building. And if anybody tries to sell you an insurance product as a way to build wealth, it's because they're an insurance agent. And it is the only product that they have to sell is an insurance product. So just beware of that. That's a huge mistake that I see people make, because the payments never stop. You have put yourself on the hook for a monthly large payment for some product like a whole life insurance policy, or even worse, a universal life insurance product. And you have told that company is you're going to pay payment after payment after payment. And that's just not, it's just not a good tool for accumulating wealth. Second of all, I see a lot of people buying insurance just basically out of fear. They had a fear of losing their money in the market, and they're not educated enough, and they got duped. And I kind of went over that in the first one, where people were just buying it because somebody printed out a document that said, okay, Mr. Smith or Mr. Smith, you put in $200 a month into this. If you die, your beneficiaries get this. And oh yeah, 20 years from now, if you continue to do this, you'll have this much cash value in it. And it looks great. It looks great to somebody who has also not been shown what that $200 a month could be invested into the market and accomplished. If you talk to people about insurance who are not educated enough, then what they are worried about is leaving their kids well off. They're not even concerned about their financial well-being. They are so worried about leaving their kids better off, or somebody in their family, or so somebody doesn't have to pay for burial, that they make mistakes financially with insurance. And so just that's the biggest mistakes, again, that I see with the insurance part of it is thinking that it's an investment and then buying just out of fear. Real estate wise, so I have a great passion and a great understanding for real estate. I've been in real estate since I was 21 years old. And I study real estate a lot. I have my real estate license, but I don't do it for buying and helping people purchase real estate. I do it for my own rentals. And so I have access to a ton of online material, county records and stuff like that always keeps me in the know. Plus, me having my real estate license helps me in my insurance and financial practice with just knowing what's going on in my community and in my state, new opportunities that come about. I just like staying in the know. My understanding of real estate really started in college. I bought all the CDs, I bought all the books, I studied all of the buying methods, all the BRRRR method. It's changed names many, many times. But the BRRRR method, the no money down method, the whole selling method, every method that you have heard about and that you see in social media, I've known for the last 20 years. It's just, again, it's just changed names. But most of it is not real. Most of it, about 10% of it, is actually real. It gives people a false impression. Again, how I talked about social media is it gives people a false impression about how easy it is. And it's not easy. Real estate is harder, way harder than taking $100 a month and putting it into a Roth or whatever amount. Real estate is probably one of the most difficult things that I do personally to grow my family's wealth. The dirty little secret that most gurus or social media, that most of them all started with one single family dwelling many years ago, and they just didn't quit. They just learned the game. They learned what made them money. And again, they're trying to sell you a concept without you, they're trying to take you from straight to Z without you fully understanding what you're buying and going through A through G, as an example. I bought my first rental whenever I was 23. So I think I had been in my job for about a year. I convinced my dad. So this is a pretty funny story. So I convinced my dad to help me buy a foreclosure. And this was a foreclosure double wide in our hometown. And I'm very glad that it was my first experience, because I learned an extreme amount about working with a property management company. I learned, I thought that there would just be people waiting to rent this property. In my mind, because that's what I had read in books, that if you buy a property, you fix it up and it's nice, there would just be people knocking on the door. And that's just not how it went down. So my dad, he co-signed with me on a personal loan at 23 years old. It took me about $30,000 to buy this double wide. Now at the time, the tax value on it was 90 grand. What I learned later on that you have to be really careful about real estate is that if mobile homes make up a large majority of the homes that are in that county, the county has to keep the tax value high or they won't make any money tax-wise. And so the tax value was like 95 grand on this double wide, but we paid, I think it was like 27,000 for it. And so I borrowed money on my credit card to fix it up. I had to pay a guy like 250 bucks a month out of my pocket to brick it. And at the end of the day, I had about 10 grand out of my pocket before it was even ready to rent. But I learned an extreme amount about this, but again, with property management. And I'm glad that this was my first one, that it wasn't some like crazy thing. But a lot of times what people don't understand is how much time and effort. At 23 years old, I was working, I had a full-time job. I lived 45 minutes away from where this mobile home was. I didn't want to ask my dad for help because he had already borrowed money. He had already helped me borrow money that he didn't have. And so I was having to drive back and forth, oversee this real estate, and then work with a property management company. And this is what they don't tell you. It just wore my ass out. I mean, I was not having a good time. It took about 6 months to get the property rented out. 6 months after all of the renovations were done. I was having to make a $650 payment every single month, all in 650 bucks on a $30,000 purchase, plus pay myself back I wasn't paying myself back, it was 650 bucks for taxes, insurance, and everything. Finally, I got it rented. Then I had to go refinance it with the same bank that let me borrow the $30,000. And here was my first mistake in real estate. The old BRRRR method was alive and well in me whenever I was 23. I did buy it. I did renovate it. I did rent it. And then I did refinance it. The bank gave me at 24 years old a $48,000 check at 24 years old, single. And what did I do? I spent every single goddamn bit of it in probably less than a year. I had the best year of my life with $46,000 worth of cash. And that was my worst mistake, is I didn't have anybody. Now my dad would have told me no, but I didn't talk to him about it because I just wanted to have fun at that age. So that was my biggest mistake real estate wise, is I just didn't have a plan on how to do what I did. I was so consumed with the refinance that I was not prepared for any of the overhead that comes with real estate. A lot of real estate, there is no monthly cash flow, because, for example, if you have a place that's costing you $700 and you're renting it for $1,000, that's only $300 a month in positive cash flow. Well, you're just a toilet mess up from wiping that $300 out. So real estate is not meant for monthly cash flow. Real estate is a great place to put money for appreciation and for refinancing later on once the rents have paid the mortgage down, to refinance and take positive equity out and then go buy more real estate. Because I promise you this, on real estate, that monthly overhead is going to come every single month. The mistakes, I wanted to go over the mistakes that I have made and then I see a lot of my clients make. So the mistakes I see people making in regards to investing, insurance, and real estate are really all education based. Everything that we've talked about, if somebody told you not to do those things, that means you educated yourself instead of you having to make the mistake to then figure it out. But again, using social media for motivation, but understand their job is to make all things look easy. It's their job to get you to buy something. A large majority of the time, it's not education. They're talking about the pros and not the cons. It is not as easy as social media. Even me, this is not the stuff I do. I make it look easy because I don't put myself in jeopardy. I understand where I have to stop, and then I put things in place that help me stay out of trouble. If you're a parent, preach to your kids about too much financial responsibility early, because if you put yourself on the hook for monthly staples, you're not going to have any money to invest. And then then as you get older, the financial responsibilities just grow. Insurance, don't get fooled into somebody selling you an insurance product as an investment tool. It is not. And I will say this again, in 20 years, I have never proposed an insurance product to a client for long-term wealth building. I've never done it. It's not a thing. Real estate, of the three methods I focus on between investing, insurance, and real estate is the hardest. You have to deal with buyers, sellers, banks, investors, partners, insurance companies, property management companies. You have to deal with people not paying. You have to deal with claims. You have to deal with constant renovations. So understanding the long-term game of real estate, as long as you understand it and you accept it, that it's not easy. Hope today's information helps you guys on your financial journey. If you have any questions, post in the comments. But until next time, be smart, educate yourself, and keep moving forward.